what is driving GME's price right now? We have a lot of new data that shows it's completely delta and option hedging through a PiFi article that just came out on Reddit.
Super stock, yeah. So just a quick heads up, this is pretty much all PiFi and his team.
100%.
Yeah. So kind of what we're just going to do is we're just going to kind of read this and call up some points and put up some pictures again from this that we think are important
to understand.
Yeah. So here is the quick overview of this. The argument that PiFi puts out is that the thing that ultimately drives the price of GME that you and I see when we go in to check it, it's really the option chain. We'll go into that in more detail in just a second. But before we get started, the reason he thinks this is that there's been a change starting in around, I think it was July of 2021, where the plumbing behind the options started to change. Based upon the prior videos, PiFi put out the thesis that in order to return the shares that were created synthetically due to ETF shorting, the people who were short would have to buy back those shares, creating pressure on the buy price. This theoretically would have occurred starting, let's say, around middle to late January, going all the way through February. However, at the same time, we've seen the GME price action go down, dipping to, I think, what was it, the low point, $88, 88 and change or whatever, past month. And so we're trying to put the pieces together and see what's going on. PiFi did his homework, and the guys he worked with took a look at it, and they think that the culprit behind this is options. Well, rather, it's the option chain that's really driving the price, and the other thing that's shot up since the 6th, I believe, of January, has been the short interest, the actual reportable short interest that we can see and the other thing that's shot up since January 6th has been the reported short interest on that.
Yeah. And just the whole market, like the entire indices of stocks are virtually driven by options. And this is just how dealers are positioning their books. And we're going to see a complete direct correlation to the delta and to the stock price. So let's roll it into the actual data.
So one of the concepts that we've got to address here to explain this is the idea of delta hedging. Suppose you're an option market maker. You do not want to be long a stock, nor do you want to be short a stock. You just want to collect a fee for making the market, for buying and selling calls, buying and selling puts. That's all that you want to do. And you've got your very advanced formulas and resources to figure out just exactly how you can position yourself so that you never are long or short on a stock. This concept essentially is delta hedging. So, for example, let's say that you are an option market maker and you're writing calls on GME. So you are agreeing to deliver however many thousands, millions of shares of GME based upon an option chain. You will know that there is a certain percentage of stock you need to have in your back pocket just to cover your case so that if you ever get the call where the option wants to be executed, you're not having to go into the market and scramble to find shares at the last minute. And this number will change almost on a day-to-day, if not a minute-by-minute basis, just depending upon where the stock price is at, where the option chain is at, how many people are buying calls, how many people are buying puts, whatever. And so the option guys, the option market makers are always consistently buying and selling behind the scenes in order to maintain this delta neutrality. So now we've got that concept in mind. Let's scroll down a little further.
And what's different really is the shorts are actually using this formula and they're driving the price down via puts, because if there is this negative delta hedging, then these market makers are going to be theoretically short stock and
selling into the market.
They're going to be driving down the market. So if they can increase the amount of puts that they have, they know that these market makers are going to drive the price down, which will help them and benefit them.
It basically makes the argument the vast majority, if not 100%, of the trading on GME is done by options. Consider this graph.
Yeah, this is just showing. If we go to a chart of GME on January 6th, here we see on January 6th when we saw this 20% run up after hours and all this buying pressure. It was the first time that we really saw this positive delta hedging. And if you know anything about options, once the delta goes positive, that's almost like a gamma flip. And these options are then going to these option makers are going to start, instead of they're theoretically going to be fundamentally short the stock, they're then going to flip, and their delta hedging is now going to positively benefit the stock. So then what do we see? We see massive put buying volume at this date. Once we saw this run up in price, because these shorts, they can't take that if this gamma flip did start to the upside. And we saw massive drawdown in this put volume, where we saw the stock come just absolutely tank in the past few weeks. Now what we could be seeing is a lot of call. What we would really need theoretically is a lot of call buying, which will then drive up this delta hedging, which will increase this gamma flip, which will make the market makers, instead of them being short delta, they're then long delta, and then they're buying into the runs, which is theoretically the best thing that we could have for us.
There's a story that was planted that GME was launching a NFT marketplace. Now, while they since have announced plans to launch an NFT marketplace, the announcement from that news story, that was not accurate. My suspicion is that if you needed a way to justify a run-up to provide cover for it, that seems like a really good way to do it. But that's tinfoil.
It's all over the place with like the stock price will justify any news story. If whatever the stock's doing, people will find a news story to fill that. Like if let's say what we've seen in all these companies, the earnings are virtually flat to barely down, and the stock will tank 20% after hours, and everyone's saying, "Oh, it's because the earnings they're tanking." What if it's not? And it's just prices of stock actually drive the news. It's not the other way around.
Yeah. So basically, just to put a bow on this, PiFi writes, January 1st and July 1st, option hedging made up only a small percent of daily volume. Option hedging, however, was significant during the February and March runs, but was low otherwise. To contrast, after July 1st of 2021, the delta hedging is between 50 to 100%. Since this estimate is fairly conservative, I can say with some confidence that nearly all of the volume we have seen on the stock since July is due to delta hedging the option chain. So there's that. The other thing that probably should go without saying is that this also suggests that retail is not selling. Question number 2 that PiFi asked, can we relate the overall delta pressure of the option chain to the price movement of the stock? The answer to that point is basically yes. PiFi goes on, I've been trying to find good correlations amongst the data for GME for a year, and I have never found one this strong. PiFi writes, I've been trying to find a good correlation amongst the data for GME for a year, and I have never found one this strong. This data, more on that in a second, shows the price of the stock correlates very strongly to the relative delta strength with an R-squared value between 0.8 to 0.9, right here.
I mean, just look at this chart. This is the price and the relative delta strength. When we see the delta rising, we see the stock absolutely tanking. When we see the delta going down, then we see the stock tanking. There's a perfect correlation here, virtually. So this is why the importance of option is to the actual underlying stock. Things are not driven by fundamentals on short-term basis. It's driven by fluctuations in market makers and these big guys that have nothing to do with anything but options, which is why we ban this on how important this delta weight is, and why we're so heavy in call options, because this is what's putting the most pressure on the actual stock.
There are 3 conclusions from this subpoint that PiFi draws. The first one being that the price of GME is determined by the options chain. Number 2, buying calls moves the price up. And number 3, buying puts moves the price down. This takes us to the short interest question. Going into January, starting about late November and December, we saw XRT, which is a retail ETF, get the bejesus shorted out of it. Josh, help me out, but I think it was, over 700% short? That was reported at one particular point in time. So the reason that you would do this is that XRT would contain GME. And if you are an authorized participant, you're able to redeem a share of the ETF or a basket. If you're an authorized participant, you're allowed to redeem your shares of an ETF to take delivery of the underlying stock that's actually comprised of the underlying stock that comprises the EFT. Now, you might have to pay it back if you borrow these shares or sell these shares short. And this is what we thought was going to drive a lot of the price action going into late January and the middle of February. XRT, if it was ripped apart in November and December to get synthetic shares of GME, and then there was a failure to deliver on these XRT shares that would have to come due in late January and middle of February. A big part of PiFi's thesis was that failure to delivers were being accumulated over November and December that would eventually have to be cleared out in late January and February. In the process of clearing out these failure to delivers, GME would have to be bought. And in the process of buying back GME to settle the failure to delivers, this would otherwise put buy pressure on the stock, sending the price higher. So we were expecting price action to the upside in January. However, setting aside today, this wasn't the case. In fact, we saw the stock dip beneath $100. I think it touched the bottom of 88 and change. And this takes us to the observable short interest. Consider this graph right here. This data takes us back to August of last year. What I find very interesting is that the reported short interest utilization, which is this orange line right here, it really wasn't that high. I mean, there's a small spike late July-ish when GME spiked, but then it kind of relatively came down. But then we saw the utilization spike up in the middle of December, come back down a little bit, but then spike up again on January 6th, right there. We also note that the cost to borrow increased. It didn't immediately increase, but it did increase in time. And again, looking at just the cost to borrow on January 6th, the day that GME ran in after hours, we see the same thing going on. The takeaway that I have from this is what PiFi writes right here. Starting in January of 2022, we begin to noticeably deviate from previous behavior. That is to say, we can see the observable short interest climb and the cost to borrow these shares climb. And this deviation is strongly correlated to the increase in GME's borrowing that's been observed by others. Bottom line is that apes aren't selling, but if the people who are short are able to borrow shares and then sell those borrowed shares into the market, that would have the effect of suppressing the price as you are putting more supply into the market and presumably keeping demand relatively the same. PiFi also notes since July 1st, 2021, all or nearly all of the trading volume of GME is likely due to market makers buying and selling the stock to delta hedge their option chain. And he also goes on to note, the impact of this option chain hedging results in a predictable change in price, indicating that much of the dip we are currently experiencing is due to shorts buying in the money puts to force the price downwards with synthetics created from market maker hedging. Fancy way of saying that if you need the price to stay low, you can go in and you can buy puts. And in the process of buying puts, you force the option market makers who are selling the puts to sell in these synthetic shares, which serves to increase the supply. You increase the supply without increasing the demand, the price should go down. So anyways, PiFi concludes with basically saying that no one is selling in retail. And there's some other things too. It's a great post. We'll put a link in the description of the video. But this is something that I see as very interesting. Hopefully it'll turn around sooner rather than later. Today was a good day, so no complaints there. But the point is that I did suspect, and Josh, I think you were kind of the same way on this, that options did, have an impact. PiFi certainly has been saying this for the better part of 6 months. It's been a long time. PiFi has been saying this.
Options drive fluctuation in dealers, and that's just kind of like what the short-term price movements are usually about. What this is pretty much what we're doing. What PiFi suggests is these far dated at the money high delta calls. Me and Justin are kind of taking a different approach, because if everything is being shorted to the extent that it is, then we think there will be that price movement with all these FTDs. So we're getting these far out of the money like 680 strikes, just because we want as much leverage for as little capital as possible. And if this does happen and the stock does start to drive up, then the delta on those will increase, which is going to cause more pressure if MOS does happen. But no one should really do what we're doing, because we are a bunch of idiots on the internet. So please do not take any financial advice. Just Justin, any last words?
Yeah, the last thing I would say is this: is that if you look at the option chain, I don't have the video, I don't have the graphic handy, but in your own time, pull up the option chain for January of 2023. I think it's January 20th of 2023, and look at the 950 strike price, and then look at the distribution of that. You have a bunch of cheap puts that have been bought, which make very little sense on the face value. And then you have a bunch of people who have bought a bunch of 950 calls. So instead of having like a normal bell curve distribution, you have the exact opposite. You have like a U is what it looks like, versus, kind of like a upside down U. So I suspect if you look at the June contract for
June 17th.
June 17th, yeah, you see 680s. There's a lot of, call interest that's piled up there. So it's very interesting seeing this. And the point from all of this is that if the price starts to run, and if all of a sudden the option market makers have a come to Jesus moment where they say, listen, we thought we were just basically taking people's money by selling them, 950 calls on GME for, January 2023. But, GME's at 500 right now, and granted, 500 is still a very long way from 950.
And I have people before that are already starting to exercise calls. Basically, these guys will get nervous, and the main thing is to exercise these calls, and that's what I think is really important for me and Justin and everyone that we're really talking to, because if you exercise these calls, this could break the algorithm. Just like LTCM, the math is perfect, and these
Yeah.
algorithms are set up in a way where math is perfect, and they have everything adjusted perfectly, but they don't account for a black swan event where instead, this is throwing numbers out my ass, instead of 3% of people exercising calls, 20% of people exercise them, and that is really what's going to break the option guys, which is going to send a spike, spend everything spiraling, plus the short interest guys, which already need a cover, sending the spike spiraling, which is really the essence of why we think a government bailout is the most likely outcome, because the option guys are fucked, the guys who are short are fucked, the banks who are on top of these guys are fucked. The contingency would grow and grow and grow. It would be a GFC type of event. Of course, if we're right about everything, which we're probably are not, which is why we suggest no one to take our advice.